All right, thank you for coming out today, everyone. My name is Dean Taylor. I'm the CEO of Diamcor Mining Incorporated. Hopefully you'll gain some knowledge about our company from this presentation and a little bit more about the diamond business and the industry and things that are going on right now. Before we get going, we'll always put up our cautionary statement. Of course, we'll be talking about a few forward-looking events and things, so that's important to go. When you look at our company, the first thing I like to talk a little bit about is just an overview. Our company is a production-focused diamond mining company. We've been supplying diamonds to some of the best guys in the world for a number of years into the world market. We do have a strategic alliance with Tiffany and Company. Tiffany obviously was bought out by Louis Vuitton recently, so it's a very good shareholder to have. They are, like I said, we have a strategic alliance and they are a shareholder in the company. We're currently in the final stages of development of a project which we refer to as Kronen Dora at Venetia. De Beers Venetia mine is one of the most prolific and significant mines in the world. It's about a $4 billion mine, and our project is directly related to it. So we kind of coexist with them and purchase this from De Beers. The current status of things, we're in what's called a large-scale trial mining phase right now. We definitely cash flow. We've spent probably close to $70 million US, somewhere in that neighborhood, in terms of building this out and developing it. We have significant infrastructure. In fact, everything's in place and we're in the process of ramping up into near-term production right now. That should happen hopefully in the quarter. And we have a 30-year mining right with a 30-year renewal, so everything is completely permitted in that. The significance of Venetia and obviously the interest from groups like Tiffany's and others would be that we have a very, very high percentage of gem and near gem quality. About 60% of what we pull out of the ground is gem or near gem quality, which is much higher. And the big benefit here is the project has been built, ready to go. We expect to see, it has potential for good cash flow earnings and things like that, starting now in this quarter going forward. And then we've got a significant area, about 15,000 hectares, or acres, that we will be then doing additional work on. So about 90% of this is yet to be defined. So it's kind of built-in cash flow, earnings, potential, with then a big upside built right in. We'll touch a little bit on the Tiffany's deal. When we acquired this from De Beers, the first thing that happened was we talked to some of the bigger guys in the world. Everything is about supply. Diamonds are very, very difficult to get a hold of, rough-wise. Tiffany's provided us with about $10 million in financing, a combination of debt and convert to equity, about 60-40 split. There's a little bit left of the Tiffany's accrued money that's there from accrued interest, but that'll get cleaned up now once we start going into this phase we're in right now this month. So there's not a whole bunch of debt in the company either. In exchange for that money, what we did was we give Tiffany's a first right of refusal. They do not get a discount. They pay fair market value for the stones based on whichever ones they want. It's not an off-take agreement or anything crazy like that. And it does exclude anything over 10.8 carats in size. So when we get stones in the field that are over 10.8 carats in size, it's termed as a special stone, and those are excluded from this first right of refusal. It's just too difficult to value that type of stone. But the idea really here in reality for Tiffany's is it's not really about the ownership or equity ownership in our company. For them, it's all about supply, and that is getting to be quite a thing at the moment. So when we look at this Kronen Dora at Venetia overview, we look at it and say, well, why is it significant? What is the big deal with this? Well, first of all, to understand that, you need to look really at what is Venetia. Venetia's essentially, it's the third largest diamond mine in the world. It was approximately 50%. It's probably higher than that now, but in the day, it was probably about 50% of what was coming out of South Africa's production yearly. At its peak, it was doing about 750,000 carats a month. It's not a year, a month, out of an open pit. So it is a very significant item for De Beers, about 9 million carats per year. Excuse me. As we said, same diamonds, same stones. So about 90% or about 60% of it is actually gem quality. The largest to date, we see some big stones. The largest that De Beers has pulled out is about 315 carats. So that is something that we like. The largest in the test phase that we've done to date is around 91.7 carats is what we've pulled out in an individual stone. So the other thing about when we look at something like this mine, you can well imagine that the significant infrastructure and benefits of being co-located with a $4 billion mine. When we negotiated the purchase, we have De Beers doesn't own any part of it, we don't pay a royalty, and we are able to use a lot of the facilities. So we have things like airport, paved landing strips, all kinds of security, different things. So it's a big, big benefit. So understanding Venetia and what it means to us is very important. Now, when we purchased this, excuse me, when we purchased this, we knew a lot about it. De Beers had done some work on it over the years. It was deemed to be non-core. They were looking at doing an IPO. Essentially, in the end, what happened was Anglo bought them out. But things like this were deemed non-core. The government of South Africa has a use it or lose it policy, meaning that you have to advance it. You can't just keep sitting on a project that's permitted. You have to advance it, you have to move it along, otherwise you lose it, give it up, and away it goes. So they had three choices. They could either sell it, they could let it go, or they could develop themselves. The decision was made to sell it. So we competed in a competitive process. Now, what we knew about this going in, they had done a lot of work, and this is De Beers information, not really ours, but when we acquired this, they had determined that about 1,000 vertical meters of the top of the pipe of Venetia had been pushed off and eroded in an alluvial fan. This is not a situation where you get in the Middle Orange where you have alluvials, rivers run through, they go over kimberlites, they drag the diamonds down, and you find them way downstream. This is the only known displacement off a primary in the world. So it's not an alluvial, but a colluvium deposit. And what we see is a shift in erosion. So there's the initial shift from the glacier, spreads it all out, and then essentially over millions of years, the rain wash brings the rest down. The deposit sits no more than 15 meters in depth is what we've seen to date. It sits on top of the bedrock, so there's no underground, there's no blasting, anything else. Our land position that we acquired with the deal is about 5,800 hectares, so somewhere around 15,000 acres, so it's a very large area, and it is directly in the known displacement area for the actual deposit, so we knew going in. There's some other detail about it. You can see from the red and the blue lines and things like that. This was information that we knew going in. We knew the main primary deposit, where it was located, and we were able to develop things and work on that from these particular information that we acquired as part of it. You can see here the outlining of it. There's two farms, the Crone one and Endora, both very big areas. We initially looked at an area, our 43101 is based on an area of about 307 hectares out of the 5,800, so a long ways to go. The yellow line represents what we did an original mining right on. When you do the mining right, you put it in place, you have about 600 and some hectares, it's a lot of area, and you put up your rehab liabilities. We'll clean up this area, and then we'll begin branching off into the other areas as it goes out further. So there's a lot of growth potential here, and a lot of upside yet that goes along with this. These are pictures of actually diamonds that we recover. This is normal stuff that we'll see, rough diamonds. That's what they look like once they're boiled and out. The one on the bottom is actually a picture of the 91.7. That is exactly that stone as it comes out of the ground. So it's one of the largest octahedrons in the world. About 180,000 carats we've taken out from to date, so roughly somewhere in the neighborhood about $31.5 million US that we dump right back into the project in terms of the development to keep dilution down. Our sales, in terms of the revenues, we built our model on somewhere around 180 to 200 US per carat. The worldwide average is about $90 to $100 average. Our last sales when we were approaching before the conflict happened, we're approaching about 329. So very, very significant increases going on as supplies become tough. Again, high percentage of gem quality we've talked about. Attractive size frequency distribution. We get a lot of stones in the 2 to 5 carat range. That's what the main buyers want. Those cut down to about 50% in size. So you're looking at a 2 carat stone being somewhere in the neighborhood of a 1 carat engagement ring afterwards. So those are the ones that are going to bring you the big money in the 1 to 5 zone. So we do have an attractive SFD, or size frequency distribution. It is exactly the same and mirrors Venetia, of course. Proven potential for larger stones. We're going to probably see some stuff up to 300 carats individually in size. Anytime you see these big stones, they can range from $1 million to $30 $30 or $40 million. So we're literally talking about a situation where when you look at the current market cap of the company, one stone can give you your market cap in straight, no cost money right out of the gate. And they are definitely there. Gem quality natural diamonds, they're just not going to, they're getting tougher to find, the prices are going up, and it's something that's going to continue going forward. We tender everything. We have facilities where we sell diamonds. We have facilities in Antwerp. We have also facilities in Dubai. We do most of the stuff in Dubai. You can see by the chart, diamond prices are obviously increasing pretty significantly. They were kind of going straight forward there for a number of years now. We're seeing these massive increases. When we look at the higher percent, as we go into the situation where we start ramping up in terms of processing volumes and things like that, we see a higher percentage as well of 10.8 carats stones and up that are being recovered. Consumer demand, even during COVID, we were amazed that as we got going and through COVID, everybody wondered if the consumer was going to go away. Brick and mortar just went down, online went up. Numbers stayed pretty much the same. I think it was shocking for everybody involved. We thought there would be some dip. It just didn't happen. The added deal with Russia now invading Ukraine, Russia, through Alrosa, the Russian government supplies about probably 30-35% of the world's diamonds. Of course, that is off limits for anybody essentially legitimate at this point. The big guys are not going to buy that product no matter what. So it's going to get interesting. The world produces about 130 million carats a year. The world was eating about 130 million carats a year, and that's been consistent for quite a while. Varies a little bit, but generally that's where it sits. You start taking 35 million out of it, and you're going to have some supply problems. There's no doubt about that. So it's going to be a bit interesting. Like we said, the geopolitical, supply considerations right now are significant. I don't think that conflict doesn't look like it's going to end anytime soon. We hope it does, but certainly I guess we'll see. The sanctions have come in. The majors, they no longer want anything to do with Russian diamonds. I don't think that's going to go away anytime soon. Demand, for non-conflict is going to, grow, obviously. Areas that are able to produce stuff and prove to guys that it comes from a non-conflict area is a big deal. And really, I guess at the end of the day, we're attractively positioned to take advantage of it. We would prefer to see that whole thing over and done with and people not suffering. But that's the reality of what we're dealing with at this point. Extensive project development. This is not just sort of a pasture or that type of thing. We were chosen in a competitive process of about 15 companies. We were chosen by De Beers to do this, to take it over. It's about a 3-year process to get chosen and buy this thing. As soon as we acquired it, we did an extensive drilling program on top of theirs. We probably drilled, 600 holes or so. We got water licenses in place. We got mining rights in place. All of these things taking time. We put about 30 kilometers of roads in, 20 kilometers of underground boreholes from 7 different boreholes that we have. We put in about a 10-kilometer main power line so that we were independent of Venetia. The installation of holding dams. We've got housing on site for about 100 people, security fences. Like I say, we developed very, very large deposit-specific plants. We have 2 of them in place, and those are being finalized and getting ready to go right now. The material initially is reduced at the one plant by about 60%. Volume-wise, we're talking about these plants having the capability to run up to as much as 500 tons per hour of material. So when we look at a 20-hour day, we're talking a significant amount of material that's going to be going through these plants. They're not small. We transport everything to the second plant, and then ultimately that's where the diamonds are extracted. We use 2 plants because we want to remove the fine material so we save on water, and it acts as pre-concentration, so it lowers the cost of our final plant in the end by doing it. Heavy equipment, as we got into COVID, that was beautiful. We bought all brand new Caterpillar equipment, and COVID hit about 3 months later. We were able to do a deal with Cat, and essentially that all worked out quite well. We used to do a lot by contractors. We just didn't find that the equipment was reliable enough or good enough for what we needed. So we ended up making a deal with Caterpillar. They do obviously supply a ton of stuff to Venetia, so it made sense to go down that road and buy our own equipment. So that was all done and in place as well. Plant refinements, as you build these plants out, we go through various stages where we determine how it's going to work, what's going to work, what doesn't work. We felt like we had some technical issues with the diamond recovery machines. That decision was made to upgrade those facilities and change some of it around. That'll be completed this quarter. These are all very much sort of the last elements as we head into this end of trial mining and the beginning of pre-production. All the stuff we're doing right now is based on mineral resource management, understanding what we've got, lowering operating costs, and the volumes are increasing quarter over quarter. We'll see a pretty dramatic increase here that we announced publicly will be done by the end of this month, and will go up quite significantly here moving forward. COVID, lockdown, current status. I won't really go too much into this. Obviously, back in 2020 when this all happened with COVID, we were exactly in the stage we are right now. We were ready to go. We were building out. We were getting everything sorted. COVID happened. I got a call from the government. We literally had 3 days to shut down this operation. Virtual impossibility. And it took a long time to get it back up and running. So COVID was a bit of a trick. There's no doubt about it. It was bad timing and unfortunate timing. Despite the fact that it was locked down, we were able to make a deal where we were able to have employees there all the time, manage the COVID thing. We have hospital, we have doctors, we have everything on site. So we were able to really conserve cash, reduce cash, and then still generate some to make it through COVID. By 2021, we were back, getting things in order, and now today we feel like we're pretty much ahead of where we were at the end of COVID. So it's actually been survivable. Current operations and the near-term objectives. Obviously, operations have resumed. We've been going now. We've had good sales the last 2 quarters. Those are increasing every quarter over quarter. And we focused on finding material that we knew from higher grade areas to generate cash flow. The current efforts right now are to double the processing volumes. That's a key priority right now in this quarter, and we're on track to do that ahead of schedule. We expect other milestones this quarter, certain things to be completed, water treatment plants, different things that are on schedule or ahead of schedule. We do run 24/7, 7 days a week, and like I said, revenue's been increasing quarter over quarter, and we expect that trend to continue. Rough diamonds all go to Dubai now. We're selling most of our stuff there in Antwerp. And these shortages, we've got another sale coming in May and another one in June. We really don't know at this point what's going to happen. All we know is we were having record highs before the conflict even happened. Then the conflict happened. There was a massive dump of stones from Russia into China, and that kind of killed the market. Now those have all been under sanction and are not really in the main market. So we're going to see what happens in May and June, but we definitely think it's going to be interesting, and supplies are going to be very, very tight. So the key areas of focus we look at, we're going to finalize these upgrades right now. A lot of them are being finished this month, and they'll be finished by the end of the quarter. Those are all designed really just to have significant increases in processing. We'll continue mining in areas that we know. We've got a lot of areas defined. We'll do further growth and expansion starting at the end of the year into the new areas so that we can really define what we're looking at. De Beers' calculation was about 50 million tons of material was displaced off of Venetia. That's about 50 million carats. Okay, so we're talking about 10 billion US at $200 a carat if you take that number. We're never going to find 50 million carats. If we find 10 million of them, it's 2 billion US. And we typically look at a target of running at about $5 a ton operating costs and gross revenues of about 12 to 15. So obviously a very profitable business. As we get this main plant up and running, cash flowing, we want to see earnings, things like that. The next thing will be the geological exercises, really which will define, okay, how big is this and how big do we want to go and when are we going to do that? Obviously our customers want us to go bigger, better, faster, quicker, but obviously we'll see what we can do with that. The other thing that these exercises are designed to do, when we get displacements like this, what happens is you'll have indentation, you'll have trap sites where a concentration of material is dumped. The other thing we're looking at when we're doing this is trying to find a concentration, right? And those can be very lucrative where we could sit in an area for a year or 2 years where we get 3-4 times the grade what we normally do. And it's just keeping in mind diamonds are heavy. They'll accumulate in those low-lying areas. So that's the other thing we want to look at as we go starting into next year. So the key takeaways when I look at this and the opportunity, we really think, you know, this is a key inflection point. We think we were there before COVID, and unfortunately COVID, you know, hurt a lot of people. But this is a high quality late stage project. I mean, it doesn't get much better than, you know, being co-located with De Beers flagship and Venetia. And, you know, majority of this displacement has not yet been found. I mean, the Tiffany and Company Strategic Alliance, we sell to about 180 guys. But obviously we have an alliance with Tiffany's. Like I said, they don't get a discount. It's all about supply. So we deal with the bigger guys in the world and the best guys, we feel, in Dubai selling this stuff. Extensive infrastructure, there's absolutely no question. We've done very well in terms of, we've probably got close to, you know, somewhere between probably 75 and 100 million into this thing in just infrastructure and time and everything else to get it to this point. So it's very, very late stage. Supply demand, it doesn't matter what happens with the conflict. The supply-demand thing was playing out anyways. A lot of the bigger mines were going off. They were getting old. There's been nothing new found. So there was going to be shortages without question going forward. So the supply-demand is very real. Not a lot of people understand it. Increasing processing volumes right now, obviously, more volume is really simple. More volume, more diamonds. That's what we're interested in. Potential for profitability, we do think that, you know, we're cash flowing now. When we look at historically, you know, we feel it takes somewhere around probably, in US dollars, we're probably talking, you know, 1.5, 1.6 million a quarter, and we're profitable. So it's a very, very efficient operation. And if you do the math based on, you know, a number of saying you want in the near term get to 15 or 20,000 carats in a quarter being sold, you can kind of figure out the math. If you change from $200 a carat and we all of a sudden start selling for 300, 350, again, the numbers get pretty attractive pretty quickly. So overall, it's a very compelling opportunity. Certainly, things are beat up. You know, we took a hit obviously with COVID. When we look at the market cap right now, it's insane. You've got a $33 million market cap. Now, we did trade as high as, you know, $100 million market cap, but with mining and stuff like this, it's, until it goes, it doesn't really seem to take off. COVID certainly had an impact. We're seeing a recovery now. It's very, very tightly held. You know, when we look at it, insiders, we own 36% of the company. I can probably tell you that there's another 35% of it that's held very tightly by a key group of, let's say, 10 people. Very knowledgeable guys. So we're in this to really for the long term. We think there's exceptional potential here for earnings, for dividends, for cash flow, and for a lot of expansion. So it is, you know, I think a very compelling opportunity. Management team, there's myself. Like I say, we have some of the best people in the world. It's not a big company, but it's a very, very good company when it comes down to who we have and who we employ. We've done it over a period of about 7 or 8 years where I've tried to pick guys that we like, that we can work with, but also they have to have the qualifications. They have to have the experience to work with us. So that is my presentation, and I am more than happy to answer any questions that anybody would have. Yep. It's, you know, it's kind of, it is a good question. The difficulty that you have with diamonds is it's not a widely understood space. And, you know, the question being, who are the comparables, right? You've got groups like Lucara and Petra and different things like that. There's only really, if you look at it, probably 15 companies in the world, of which, and the thing of it is if you look at it, you look at the entire market, you got 35% of it that is Alrosa. That's the Russian government. They're public now, but not public. You know what I mean? De Beers, 35%, right? And before, it was definitely not public, and now it got sold to Anglo, and now it fits in with Anglo. That's 70% of the business. It goes from 30 guys that produce 30, 35 million carats. The top two, they argue over who's the biggest. There's no question Russia was the biggest by volume. De Beers is the biggest by dollars. That's the argument those two always have, right? Then the next guy down might do 4 million carats. The next guy down might do 1 million, right? If we get this, our goal would be to say to get to about 120,000 on this project, you know, carats a year would be a good starting number. If you do that, you're probably in the top 10 in the world. And unfortunately, this isn't like gold where you have 1 billion companies that you can value and everybody follows it. It's a really, really unique business. Lucara is probably the closest. They're bigger. They're going to go underground. They're doing open pit right now. I think valuation-wise, what we talked about, I talked about with some pretty, some nice, good banking guys and different guys like that. I believe that the company has the potential, and I think a fair valuation. If you find 10 million carats, and it's worth $200 a carat average, and you have the potential to say, let's say, generate $2 billion. And if you can show and demonstrate quarter over quarter that you can operate at, say, 50 cents on the dollar dropping to the bottom line, you've got $1 billion in, say, after-tax earnings. Discounted cash flow, 15 years or whatever, you're going to come up with 400, 500, 600 million. I've always said to guys, look, our target's probably 100 million in the very near term as we launch. The next goal or potential would be to see somewhere between 200 and 400 million. And if we can do it all without cash, like without dilution, we don't see any need for any dilution or any raises coming. Liquidity could be a problem where we may do a raise at a much higher number just to basically try and get out of liquidity because it's very tightly held. For sure. Yeah, 60% is probably pretty tight. Look, we did raises. We had some of the best funds in the world, like pre-COVID when we raised, at a couple of times we raised like $10 million type of deal. And those raises were done at $1.10, and they were, we had groups like AGF Fund, had us as #1 pick on BNN in Canada. They came in for $5 million at $1.10. Vertex One Fund, same thing, $5 million. When we look at a lot of the stuff, it's hilarious. My cost average, myself, would be somewhere in the neighborhood of close to $1. And we didn't sell. We were up at around $1.80 because at the end of the day, the only reason we've got 130 million shares now is because when COVID hit, we had to make a decision. I went to the top shareholders, 20 guys, and I said, guys, here's the deal. We're never going to make it through this COVID, right, without raising some capital. We don't want to take any more debt on, right? The debt we've got is extremely friendly with Tiffany's, right? So we don't want to play around with that. We got to do one of two things. I can easily go raise money at the levels we're at, or we can just we can either do a rights offering, or I can just get commitments from you guys. But we're going to have to put together $3.5 million to survive this COVID thing. And so ultimately, we had 100% participation, and we took it all down ourselves and said, that's it. And that's where you get this higher insider and guys owning a lot of shares. In the end, what you'll do is, once the stock is up to a reasonable level, you'll be able to go to a certain bigger guys, institutional guys, family office, maybe put a block in their hands, get them somewhat, you're never going to give them all they want. You want to see that movement. As we go, we'll spend more and more money on marketing. What we'll do is we'll get the retail element, even though we know they're going to trade the stock out and that. We need to get the liquidity. We need to get the volume going. And it certainly doesn't hurt if say, 6 months or a year from now, all of a sudden you look at it and say, hey, you know what, for another $20 million, we can double the size of this plant and throughput, and we've done the research and geology on the outside areas, we can double this production for $20 million and it pays itself in a year. That's good use of proceeds where you can now go to good institutional guys or a banker and say, okay, I'm not raising money here at 30 cents because it's too diluted, you know what I mean? But I'll definitely do $10, $20 million to clean everything up. The goals this year will be get it up running, get it into, the volumes up, get it into production type of thing, make a formal production announcement, get going on the exploration, and then get the balance sheet so I have no debt left by the end of the year. And I think if we do that, we have the potential to again be at that $+ range, and then you can make some decisions. But we'll do it as a group, essentially with the larger shareholders sitting back and saying, okay, guys, what do you want to do here, right? If we've got a liquidity problem, right, then and these are smart guys. They're intelligent guys. They'll make the decision based on knowing what we need to do. So, yeah, no worries. Anything else? All good. Well, I appreciate everybody coming out. Thanks a lot. Cheers. If you have any questions.